What's driving markets in 2026? Markets started the year on steady footing, but what's driving them has clearly changed. Geopolitics, inflation, and interest rate expectations are now playing a larger role in shaping market outcomes. We'll break down what this means for stocks, bonds, and the broader economy in this quarter's investment perspective. How have geopolitics impacted stocks and bonds this quarter? Markets began the quarter on relatively stable footing, supported by steady earnings and a still constructive policy backdrop. But that changed late in the period as the escalating conflict in the Middle East shifted sentiment and increased volatility across markets. Stocks pulled back after reaching higher levels earlier in the quarter. The sell-off was broad, driven by rising uncertainty, pressure on valuations, and closer scrutiny on earnings, particularly within technology and AI-related companies. At the same time, leadership began to shift, with smaller companies and value-oriented stocks holding up much better than large-cap growth stocks. Bonds also faced pressure, but for a different reason. A sharp rise in energy prices pushed inflation expectations higher, which pushed interest rates higher and weighed on bond returns. By the end of the quarter, markets were being driven less by economic and earnings data and more by how geopolitical developments were expected to influence inflation, interest rates, and growth. Stock and bond outlook: a more balanced yet less uncertain path. Looking ahead, market returns are likely to be more measured as expectations reset. Valuations remain elevated, and markets may be more sensitive to whether earnings continue to meet those expectations. That could lead to a less consistent path for stocks, with periods of volatility tied to earnings results, interest rate expectations, and shifts in sentiment. Interest rates and central bank policy should remain key drivers. Central banks may gradually lower rates over time, but the path is likely to be uneven, especially if inflation pressures tied to energy or geopolitics persists. That could keep rates higher for longer than previously expected. In this environment, bonds should continue to provide meaningful income and may offer stability during periods of stress. At the same time, stock market leadership could continue to broaden, reflecting a more even distribution of earnings growth across company sizes, sectors, and regions. Why has growth slowed and inflation picked up? Economic growth remained resilient during the quarter, but the pace slowed. In the U.S., consumer spending continued to support activity, helped by steady income growth and a still solid job market. Business investment was more mixed outside of the continued spending tied to artificial intelligence. Outside the U.S., growth softened more noticeably. Higher energy costs and weaker industrial activity weighed on parts of Europe and Japan, while growth across countries started to vary more. Inflation also became less predictable. Rising energy prices pushed headline inflation higher, even as underlying trends remained relatively stable. This highlighted how sensitive inflation can be to external shocks. At the same time, labor markets showed early signs of cooling. Hiring slowed and job openings declined, and employment edged slightly higher, while central banks largely held rates steady as they balanced slowing growth with renewed inflation pressures. What could shape growth and inflation next? Looking ahead, economic growth should remain steady but continue to slow. Consumer spending is likely to remain a key driver, though at a more measured pace, while businesses may become more selective with hiring and investment. Inflation should trend lower over time, but the path is unlikely to be smooth. Areas like housing and services may remain more persistent, while energy prices could continue to move with geopolitical developments. Central banks are likely to remain cautious. Interest rate decisions should stay closely tied to new economic data, particularly around inflation and employment. At the same time, labor markets should continue to cool gradually with slower job growth and more moderate wage gains, helping to ease inflation pressures without a sharp rise in unemployment. How do geopolitical events impact stocks, inflation, and interest rates? Recent developments in the Middle East have raised an important question for investors. How much do geopolitical events actually matter for markets? Headlines around conflict can feel inherently market moving, and in the short term, they often are. But over time, markets tend to respond less to the events themselves and more to how those events affect the broader economy. The key channel is energy. When conflict disrupts supply or transportation, energy prices can rise. That can influence inflation, borrowing costs, and business expenses. And those are the factors that ultimately shape market outcomes. Duration and scale also matter. Short-lived disruptions have historically had limited lasting impact, especially when supply adjusts. But more sustained disruptions, particularly those that keep energy prices elevated, are more likely to influence inflation, central bank decisions, and economic growth. We're already seeing these dynamics play out. Energy prices and gold have moved higher, reflecting concern about supply and inflation. At the same time, bond yields have risen, suggesting markets are more focused on inflation than on slowing growth. Meanwhile, broad stock market indexes have remained relatively stable, but beneath the surface, leadership has diverged. Energy and material stocks have generally moved higher, while more economic and rate-sensitive areas like consumer discretionary and financial stocks have faced pressure. The takeaway for investors is not to ignore geopolitical risks, but to keep it in context. Markets tend to be shaped less by the headlines and more by those events that meaningfully change the path of inflation, interest rates, and earnings. How to build a resilient portfolio in an uncertain market. Recent market behavior has reinforced a simple idea. Portfolios need to be built for a range of outcomes, not a single scenario. Different asset classes don't always move in predictable ways, especially over shorter periods. That's why diversification across stocks, bonds, real assets, and select private investments remains important, so outcomes are not tied to any one driver. At the same time, market leadership can shift. A relatively small group of companies has driven much of the recent performance, but that leadership has already started to broaden. Maintaining exposure across sectors, regions, and company sizes can help reduce reliance on any single theme. Bonds continue to play an important role. They provide income and have historically helped stabilize portfolios during periods of slowing growth or economic stress, even if that relationship doesn't hold in every environment. Real assets like infrastructure and real estate can also add diversification, particularly when inflation is less predictable, by providing income and tying returns to real economic activity. Private investments can offer access to different sources of return, but they require thoughtful sizing and a clear understanding of liquidity. Ultimately, periods like this can create uncertainty, but they also reinforce the value of staying disciplined. A well-diversified portfolio aligned with long-term goals remains one of the most reliable ways to navigate changing market conditions.
If you found this information helpful, please click like. Click the subscribe button to be notified of future videos. Thanks for watching.